Hello traders, Bill Duryea here with Follow the Bots. Our trade strategy review consists of going over the trade opportunities that developed during a particular session. The point of the review is to discuss the market developments along with the indications that occurred at each of the potential trade levels. The purpose is to observe and take note and to annotate what had occurred and to go through the logic behind the trade decisions that developed during that session. We're going to start first of all with the pullback following the FOMC announcement and the overnight breakout above 1650. If you notice on the charts that I put up on the website, I indicate clearly what the known resistance levels are, and I classify these levels by the distance that the market has either pulled back or retraced from prior highs and prior lows. If you look at the chart, for example, that I've posted here, let's start down here with the minor pullback to the 1630 level. Here's where the digital filters turned up. This is where the up move began. This is where the bar traded up to and above the prior high. So this becomes a key observation. This is how we determine, using market structure, where support developed. Notice again here the market pulls back, equaling the previous high, and then rallies up off of that price level and makes yet again a higher high. The next pullback did not retest what was the prior low. The market held support above the prior low, and the indication is not as clear as it would have been in terms of a reference had the market pulled down to previous support. This occurs sometimes, more often perhaps than we would like. It is referred to as the fractal nature of the price structure. The logic behind it is that, first of all, no one wanted to sell back down to the prior day's low. So that's one component of the logic. Secondly, buyers were sensing the market was going to go higher, and they were willing to pay up and not wait for the market to pull back. They were willing to start buying early. And indeed, as you can see, after this prolonged period of flat price activity, the market did eventually trade above the prior high and made a higher high. This pullback is a better reference, and while the market still did not auction back down to the previous day's low, it did pull back to the prior day's low, and that's a clearer or more easily understandable reference point. Notice I also indicated here where the market pulled down and what the down bar was. Here we have an upturn in the price average, and this is the overnight session. So this was, if you weren't up and trading overnight, this was the best opportunity, and it was unfortunately a missed opportunity if you only trade the day session. During the rally to the new high on the path up to 1670, there was only this minor pullback at or near 1660. If you were looking at a volume at price chart, you would see that the initiated if you were looking at volume at price data, you would see that the highest volume initiated buying was below the 1660 price level. The reference was closer to 1655, 1658. Then the market trades up not exactly to resistance at 1670, falls short before the pullback, rallies up to the known resistance level, pulls back. The pullback equals the previous high, so the previous high being the reference point because that's what the market broke out above. Granted, these are minor opportunities, but nevertheless, they're the opportunities that the market offered. And despite the fact that they may not be the most attractive and the most desirable trade locations, the reference points, the pattern, in other words, higher high, pull back to the previous high, these are things that we have to annotate and take note of. And the market went on to make a higher high, trading slightly above known resistance at 1670. Let's take a more detailed look. So what were the trade opportunities? First of all, the pullback to the previous low, down at or near 1641. What was the expectation? The expectation would be a retest of the previous high. The next trade opportunity, buy the breakout above the previous high. What would be the expectation? Price would auction up to the next known resistance level at 1670. An aggressive short just below the prior high. No clear reference on this chart, but when we look at the order flow monitor, you'll see that there was lack of buying interest as well as high frequency selling. Pullback, not very clear, but if you look at the order flow monitor, you'll see sell programs waning followed by a buy surge. This is where the structure, the market structure, the support and resistance levels that we can easily identify are enhanced with the use of the order flow monitor. The averages turn up, the market rallies up to known resistance. At known resistance, also buy programs waning, opportunity to go short. The outcome, unfortunately, modest. No real pullback. I would have thought myself the pullback would have been more substantial, at least trading down to 1660 again and testing the low here at number 4, but the market pulled back only to 1666. The opportunity, buy the pullback. Expectation, retest of the high. Retest of the high occurs, buy programs waning. Buy the pullback. Expectation, retest of the high, possible probe for stops. So this is the logic of the pattern that developed. These are the type of things we talk about in our trade strategy bulletins. Let's take a look at what happened now during Friday's session, and let's look at how the order flow monitor provided additional clues to help us in our decisions. So here we see where the sell programs were waning down at or near 1661 prior to the market auctioning up to 1668. Notice here on the rally to the high, the order flow monitor indicates resistance in the form of buy programs waning. Ideally, we would have liked to seen this occur at 1670. We would have wanted to see the market march up to the known resistance level, and that would have made our decision easier. But again, everyone knew where resistance was at 1670, so buying backed away a little early, and sellers came in and hit the bid. Now we see the market pulling back to at or near the inflection point. This is a very important micro reference to take note of. An inflection point indicates where a curve turns either positive or negative. Now, time series is notorious for being noisy. And so minor little turns like this, where the end result is simply a couple of points, are not very significant. But here you have a turn that resulted in from the 61s up to the 68s. Now, it would have been better or more significant, shall I say, had it gone up to 70. Then that would have been a significant turning point. And so you look for pullbacks to these areas. They don't necessarily mean buy them just because it was a prior inflection point, although experienced traders might consider that. But they're areas where you would logically expect to see on a pullback the market find support. And the indication from the micro order flow events telling you that the likelihood of the market finding support are, first of all, sell programs waning. Now, there are many more subtle micro events that the order flow monitor will detect, and Carl Weiss is more adept at pointing these out than I am. As I've mentioned many times before, I look for the order flow events at key levels. Carl has a greater expertise in identifying the order flow events where they're not necessarily related to a reference point, or perhaps they come slightly after a turn up off a low or a pullback off the high. So here was the opportunity to buy the pullback at or near the inflection point at 1662. 61 would have been the target. It fell shy of there. You had to be slightly aggressive and take the 62s. As you can see, we clearly expected the market to trade above this minor high at 68 and continue auctioning up to the known resistance level at 1670. Now we see the follow through off the pullback to 61, where the market pauses slightly before retesting the high, goes on to trade above the high, and auctions up to the known resistance at 1670. Now you can see the order flow events which occur when price rallied to 1670. First, you get buy programs waning. That simply means that the bots, the electronic algorithms, are no longer triggering trades on the buy side. Following that, you get the high-frequency sell surges, and while not necessarily the greatest trade in the world, it certainly paid off easily 2 points, pulling back from 70 down to 68. Notice on the move up, now this is where Carl is more adept at identifying these micro signals than myself. Notice here that you have on the move up, in other words, if you for some reason thought I shouldn't get long at 61, or you failed to get long at 61 and you wanted to take the trade later, here you're getting indications from McDaddy with a series of higher highs, and you could have bought late and you could have rode it up from 64 up to 70. Now we begin to get the pattern that developed at the high. So after the initial buy programs waning, there's another uptick to 70. The averages are starting to fade or to turn down. And even though there was one final high-frequency buy surge, it didn't really result in a higher high. So had you been short at the prior high, 70, 71, there wasn't any real reason to panic or abandon the trade. Then after trading up to the 70-71s, the S&P pulls back again and retests the late off the low target down here at 66. During the remainder of the day, there were just minor scalping opportunities. The market was flat for a very long time. The overnight low at 66 was never really tested. The lowest the market traded down to was 67.68. Then following the pullback down to 67.68 after the period of non-directional flatline activity that dominated into the close, the market rallied back again up to the high. There wasn't any indication on this probe above the prior high that buy programs were waning, but we know that typically stops are resting 2 points above the previous high, and so all the market managed to do was auction up, take out the stops above the prior high, and then pulled back to 1670, which is more or less where the S&P opened on Friday. So there were really no gains relative to Friday's open. The narrow trading range was below average, the volume was below average, and the market basically stalled and paused at known resistance 1670. This type of trade strategy review is very valuable. Whether you chose to take any of these trades or not is not as important as is the review of what happened, and it gives you the opportunity to reflect upon your thinking at the time and to take note of the nuances that developed in the order flow during Friday's session. Now, the next time a similar session develops, if this is the very first time you've ever seen a pattern like this, you may have had no reason to think the market was going to go up or down. I mean, if you're looking at it for the first time, this is your first observation. It's for this reason that the observations should be noted. The charts should be annotated. And as you begin to accumulate a body of evidence, so that means you save this pattern, you categorize the pattern, classify it, narrow range day, below average volume, only 7-point trading range. If you save this in a folder and titled it below average day trading range, and every time you observe a pattern like this, a rally up to a known high, remember it broke out above 50, so this is some 24 points above the previous high. The next time this type of event occurs, and believe me, this type of an event will occur, they happen over and over and over again. If you do a similar review of your thoughts at the time, and then save that chart in the same folder, by the time you have accumulated 20, 40, 60 examples, you will then be able to go back, and the next time you see a development like this, you'll be better adept at identifying the subtle nuances and coming up with the appropriate trading strategy. So that includes our trade strategy review for Friday's market development, and we'll look forward to seeing you Monday morning at the open.